You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the deep dive. Today we're looking at a pretty dense global market briefing. Lots of complexity.
Yeah, the kind that can easily swamp you.
Exactly. So our mission here is really to cut through it all. We want to pull out those critical connections, between currency moves, commodity trends, trade policy.
And that big overlay of geopolitical risk that ties everything together.
Mm-hmm.
We're aiming to give you that shortcut, basically, to get you up to speed on the big macro shifts happening right now. And it's crucial to understand that central bank policy, it's not in a vacuum anymore.
Right.
It's deeply tangled up with things like supply chain shocks, refinery attacks, shifting alliances. They're completely intertwined.
And that collision is driving the volatility we're seeing.
Absolutely. That's where the volatility is coming from.
Okay, so let's structure this. We'll start with the money, right? FX, central banks, that whole policy tightrope.
Makes sense.
Then we'll pivot to the physical side. Commodities, security risks.
The real-world impacts.
Yeah. And then wrap up with the policy moves, trade, diplomacy, all that. So let's dive in. Monetary front first. Hashtag tag the policy tightrope. All right, so looking at foreign exchange. The dollar took a bit of a breather, didn't it? After hitting, 97.92 on the DXY?
Yeah, midweek peak, then it eased off. We're seeing the euro sort of drifting back towards 1.175.
And sterling's holding its ground near 1.3550, so kind of settling movements.
Consolidation, mostly.
But one thing really jumped out, that PBoC fix. The People's Bank of China setting USD-CNY at 7.1118.
Right, and the street was expecting something more like 7.1293.
So significantly tighter. Why do those little decimal places matter so much? Why should you, our listener, care?
Well, that's a great question because that difference, as tiny as it seems, it's actually a massive signal.
Okay.
When the PBoC fixes tighter like that, making their currency stronger than the market thinks it should be, they're basically saying, whoa, hold on, they're resisting rapid depreciation.
Putting their foot down a bit.
Exactly. It's a move for stability. A subtle hand on the tiller, but firm. And that's precisely what currency traders watch when they try to read China's policy mood.
Got it. And that sets the stage nicely for the complexity we see elsewhere, especially with the Fed, right? We've got these two quite different takes coming out.
Oh, absolutely. The debate under the dollar's surface is anything but settled. You had Mary Daly from the San Francisco Fed. She framed that recent 25 basis point cut as insurance.
Insurance, okay.
But the really telling details she included, she said, and I quote, inflation excluding tariffs is roughly 2.4% to 2.5%.
Ah, excluding tariffs.
Exactly. By focusing on inflation without tariffs, she's kind of implying the Fed should manage the core domestic stuff and, look past these external price spikes from trade policy.
Which is one way to view their mandate, for sure. But then you have Austin Goolsbee at the Chicago Fed sort of pushing back on that very idea.
Right. Goolsbee's warning against overly front-loading the easing.
And his reasoning.
He's pointing to the steady jobs market, but also that persistent, uncertain inflation pressure that's coming directly from trade policy uncertainty.
So one voice saying, look through the trade noise, and another saying, hang on, that noise is inflation we might need to worry about.
That's the tightrope walk. Perfectly put.
Is it just the U.S. grappling with this, or is this a global thing?
Oh, it's everywhere. We see these policy contradictions popping up all over. The Bank of Japan minutes, for instance, showed a really divided board. Some members clearly see room to raise rates when possible, start normalizing. But others are hitting the brakes, saying patience, because they're worried about what the U.S. might do policy-wise.
So U.S. policy uncertainty is rippling out.
Big time. And then across the channel, you've got Megan Green at the Bank of England, an external member, arguing policymakers might need to actively offset supply shocks, not just look through them.
Actively offset, that sounds different.
It is. She basically said inflation risks have shifted more to the upside, even if some trade risks seem to be easing a bit. It's a significant shift because it suggests targeting supply-side problems directly.
Which isn't how central banks usually operate, is it?
Traditionally, no. They focus on demand.
Yeah.
So this is a potential change in thinking driven by these persistent shocks. Tag commodities as a geopolitical sensor.
Okay, that idea of policy versus physical shocks leads us perfectly into commodities, because they seem to be acting like a real-time geopolitical sensor right now. Crude oil, for example, slipped a bit, but still feels incredibly twitchy.
It does. Very sensitive to security news. And the sources actually pinpoint why. There was that report about Rosneft's Novokubishevsk refinery.
Right, the drone attack.
Exactly. It halted processing on September 20th after that attack. That's a tangible hit to supply and major facility impacted. It just reinforces why the market's so sensitive to anything affecting Russian supply durability.
But here's what's fascinating, right? We also had those headlines about unidentified drones over Danish airports.
Several airports.
And one, Aalborg, actually had to close temporarily, yet oil prices barely moved on that news.
And that contrast tells you everything. The market isn't just pricing general anxiety or, drones are scary.
It's pricing specifics.
Specific, tangible supply disruption. A refinery hit means barrels off the market right now. Drones over an airport. A major security worry, absolutely, but it doesn't immediately change the flow of oil globally. It shows a really sophisticated, discerning risk assessment happening in real time.
Okay, moving off energy for a second. Gold steadied, pulled back a bit from near $3 to $800 an ounce. Looks like maybe just quarter-end profit-taking, cooling off the safe haven bids.
Yeah, that seems like the most likely explanation. Standard flow stuff cooling things off after a run-up.
Let's spend a moment on copper, though. LME Copper retraced some of its recent rally. Is that just short-term noise, or is that longer-term bullish story starting to, fray a little?
I'd say the retracement is mostly noise. The long-term story seems pretty defined by this deep structural supply issue. And remember, that rally was really kicked off by the news about Freeport-McMoRan's Grasberg mine.
The force majeure, right. For listeners maybe not familiar, that basically means an unavoidable catastrophe lets them off the hook for delivering supply they'd contracted.
Essentially, yes. And the scale of this Grasberg problem.
Okay.
It's huge.
How huge?
Well, this is what you need to focus on. One major bank put numbers on it. They're expecting a loss of about 250, maybe 260,000 metric tons of copper just from Grasberg in 2025.
Wow, okay. That's substantial.
It's massive. And as a direct result, they've had to trim their global mine supply forecasts for both 2025 and 2026. So you've got this big physical constraint hitting right when global demand from electrification, EVs, grids, all that is ramping up.
So it reinforces that bullish view.
Absolutely. Reinforces that structurally bullish longer-term view, as they put it. It's fundamentally about a physical shortage.
Yeah.
Tag, industrial policy and shifting alliances.
Okay. Shifting from physical shortages to policy maneuvering. The trade landscape seems really active, and it's going way beyond just tariffs now.
Yeah, this expansion of what counts as industrial policy is happening fast, especially in the U.S. And what's really fascinating is just how broad the focus is becoming.
Like what?
Well, the U.S. opened a Section 232 national security probe. Now, usually that's for stuff like steel, aluminum.
Right, traditional heavy industry.
Exactly, but this new probe, it's into imports of robotics, machinery, and even medical devices.
Medical devices under national security.
Yep, that's a huge signal. It tells you Washington's definition of critical national security tech now stretches into advanced factory automation and healthcare technology.
And that ties into the strategy around critical inputs, too, like rare earths. We're seeing attempts at coordination with allies there.
Highly complex coordination attempts, yeah. They're looking for something pretty unprecedented. The U.S. is talking with G7 and EU partners about broader measures.
Broader than just tariffs.
Potentially. This is the key detail. Maybe tariffs or even price floors to stop rare earth price dumping.
Price floors. That sounds radical.
It is. It's not just about protecting your own producers. It's about setting a minimum stable price globally to make investment outside of, say, China viable for these critical minerals.
Yeah.
It shows a really deep, coordinated push, viewing this as a long-term geopolitical vulnerability, a supply chain stability play.
Okay, shifting focus to China. We've got sort of parallel tracks happening, some resolution, some friction. Like the TikTok deal looks set to be signed.
That's the expectation, yeah. But separately, you've got this non-principal level Chinese delegation. So not the top bosses at the U.S. Treasury right now for technical talks on trade.
Technical talks, meaning?
Meaning the sources were really clear. This isn't a high-level negotiation round. It's not about TikTok. It's the technical staff working through the nuts and bolts of trade mechanics.
For keeping the functional channels open, even with high-level tensions.
Exactly, which is interesting in itself.
And then, across the Atlantic, new tensions bubbling up, but this time over services, not goods.
That's right. Washington put out a warning to European countries basically saying, don't restrict air travel in ways that violate our bilateral agreements.
So flexing muscles on services trade.
Yeah, showing a much stronger enforcement stance there. It proves the policy focus isn't just manufacturing inputs or minerals. And if you link that to the bigger alliance picture, Treasury Secretary Bessent has been out there really emphasizing the strength of the U.S.-South Korea alliance.
And there was talk of an FX swap line.
Seoul mentioned discussions, yeah. If that actually happens, it's a huge headline for stability and definitely something FX traders are watching very closely for any follow-through.
Plus, we have the planned presidential visit to Japan coming up late October. Focus there seems to be defense, tech, supply chains.
Right, so alliances are clearly being tested and reinforced, sort of, all at the same time. It's a very dynamic picture. Hashtag tag geopolitical flashpoints and risk premium. Okay, let's quickly run through the most urgent security stuff. Because these feed directly into that geopolitical risk premium the market is always trying to price. We mentioned the drones in Denmark.
Right, which did cause that temporary airport closure at Aalborg, so a clear security disruption, even though oil didn't react much.
Correct. And then more globally in the Middle East, there was news of a pretty comprehensive plan being presented.
A Gaza plan for de-escalation.
Yeah, reportedly U.S. presented and got some regional support. And the plan itself is ambitious, very long range. We're talking release of all remaining hostages, a permanent ceasefire, phased Israeli withdrawal,
Okay.
and then a whole post-war governance and security framework involving Palestinian and Arab Muslim forces, plus significant reconstruction funding.
Wow, that's a complex roadmap.
Hugely complex.
Oh.
But any sense of forward movement there would obviously help de-escalate regional tensions.
Contrast that sort of roadmap approach with the very immediate pressure being put on Iran over the nuclear program.
Right. France, Germany, and the UK just pulled the trigger on the UN snapback mechanism.
The snapback.
Yeah.
Remind us what that does.
It's designed to automatically reimpose previous UN sanctions on Iran aimed at stopping them getting a nuclear weapon. It's a strong diplomatic tool, a real pressure tactic.
But is the door closed?
Apparently not entirely. Paris immediately noted that a deal is still possible if Iran lets the international inspectors back in. So it's a very calculated move, show force, but leave a diplomatic opening.
Okay, bringing it back closer to home, domestic turbulence also adds to that global risk picture, doesn't it? Like the U.S. OMB telling agencies to prep for shutdown contingency plans.
Absolutely. That's a clear signal that domestic political gridlock here in the U.S. is a real economic risk. Markets definitely track that for potential hits to growth and sentiment.
And that domestic stuff can feed into the alliance picture too, right?
It does.
Yeah.
This is maybe the crucial implication we need to touch on. There are reports citing EU leaders who are, frankly, increasingly seeing Washington as a less reliable ally.
Less reliable because of...
Well, worries about new U.S. rhetoric on Ukraine, potentially shifting blame if Kyiv falters. That perception that the U.S. commitment might be wavering, that the alliance umbrella isn't quite as solid, that's the policy uncertainty premium that markets are starting to have to price in.
Into everything.
Into everything from defense deals to international cooperation efforts. It creates friction.
So, okay, if we try and consolidate this whole view we make, divided central banks, twitchy energy supplies, complex diplomacy, alliance worries, what's the single takeaway message for our listeners right now?
I think the main message is that this consolidation phase, we seem to be in the dollar settling, markets taking breath, it feels fragile.
Okay.
You've got a steadier dollar, yes, but the policies underneath are pulling in different directions. You've got copper defined by physical shortages that aren't going away quickly.
Years, maybe.
Could be years. And oil is just hypersensitive to that constant stream of security news, geopolitical events that could instantly take capacity offline.
So the foundation is just incredibly sensitive. A domestic political fight, like a potential U.S. shutdown, hits sentiment hard.
Right.
And meanwhile, a drone attack thousands of miles away can reroute global energy flows basically overnight.
These risks feel more interconnected than ever.
They absolutely are. And the kind of coordination you need to actually manage these interconnected risks, it's massive.
Which leaves us with maybe one final provocative thought for you, the listener, to mull over.
Go for it.
Given those reported anxieties from EU leaders about U.S. reliability, that core skepticism about alliance trust we just talked about, how does that affect those really technical, really important discussions happening now about curbing rare earth price dumping? The ones that need deep, coordinated G7 EU action, maybe even those price floors. How well can that coordination work if there's this perceived fracture in alliance stability underneath it all? That's a great question. That's maybe the hidden cost, right? The true cost of that policy uncertainty premium we mentioned. Something to think about.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.